Diminishing Misaka used in house purchase. The client will join with the financier in purchasing the house. They will own the house jointly. The financier will lease his undivided share in the house to the client partner. The client will pay predetermined rentals to the bank. Along with the rentals, he will also keep purchasing the bank's units, ultimately returning the bank's capital. The client and the bank will share both the reward as well as the risk in proportion to their shares. The capital share of the financier is gradually reduced and correspondingly the rental also diminishes. When the capital invested by the financier is wholly repaid, the client will own the house completely.
I've also heard about sukuk, which are based on musharaka.
Yes, investment certificates and sukuk are another application of musharaka. Companies issue participation certificates to get partnership capital. Musharaka certificates, musharaka sukuk or partnership-based term finance certificates are all based on the rules of musharaka. These are alternatives to conventional debentures. The basic differences between a mudaraba and a musharaka.
What are the differences between mudaraba and musharaka?
The differences between mudaraba and musharaka. In mudaraba, the capital is put in wholly by one party, whereas in musharaka, all the partners are investors. In mudaraba, the capital investor cannot take part in the day-to-day management of the business, but in musharaka, all the partners have the right to take part in running the business. In mudaraba, the losses are borne entirely by the capital contributor. But in musharaka, losses are borne by all the partners. In mudaraba, liability is limited to the capital invested, and in musharaka, liabilities are usually unlimited. In mudaraba, in some cases, mudaraba assets may belong only to the financier. Only the income might be shared. But in a musharaka transaction, all assets are joint property of the partners on pro rata basis.
I think the musharaka contract will be perfect for our requirements. We will discuss this further and get back to you in a day or two. Thanks for the valuable information.
You're welcome. What we have learnt in this module. The financing technique of musharaka. A musharaka is a partnership where two or more financiers provide finance for a project. All partners are entitled to a share in the profits resulting from the project in a ratio which is mutually agreed upon. If there are any losses, however, these are to be shared exactly in proportion of capital invested by each partner. This form of financing is useful for any manufacturing, trading, and other business ventures where the bank is willing to act as a partner. Diminishing musharaka has been used mostly in house financing. Musharaka is also known as joint venture facility or partnership financing. The accounting procedures in a musharaka and all about projected profit margins to be paid every month, which will be adjusted at the end of each financial year. There are three main forms of musharaka: permanent musharaka, temporary musharaka, and diminishing musharaka. We learnt the main differences between these three types. How each of the types of musharaka gets terminated. The main differences between a mudaraba and a musharaka. You may now reinforce your learning by going through this topic in the illustrated textbook and check your comprehension of the subject by attempting the questions in the workbook. Rules for a valid tabarruk. Rule number 1. Sale and repurchase is not permitted by Sharia. Let us look at our earlier transaction in a different way. You buy the car from A on credit. Then, instead of selling it to B, you sell the car back to A for cash. This is a case of sale and repurchase which is not permitted by Sharia. The correct transaction will be, you buy the car from A on credit and then sell it to B on cash payment. Rule number 2. There must not have been a prior arrangement between the three parties. Rule number 3. There must be an interval between each purchase and its subsequent sale. This is to expose the parties to price risk. Gains from the transaction should be a reward for risk borne. For Sharia compliance, it is necessary that actual purchase and sale should take place along with transfer of ownership and related risks. So as I said, I need about 70,000 dirhams. How do we go about it? Islamic covered cards. Using the Tabarak mechanism, let us suppose that the Islamic bank, acting as your agent, is able to sell copper for 10,000 dirhams. Under the Wadi'a principle, the bank is a safekeeper of the funds. Now, instead of crediting your operating account with the sale proceeds, the bank creates a guaranteed current deposit account for you for 10,000 dirhams. This will be your covered card limit. You can use the card for retail purchases and cash withdrawals just like a conventional credit card. Your transactions will be backed by the cash held in your Wadi'a account. This mechanism is entirely in compliance with Sharia. The card should not be used for items disqualified by Sharia. However, experts are not in favor of open use of Tabarak. They allow its use only for corporates. Renowned scholar Dr. Ubaidullah of Islamic Development Bank Jeddah says about Tabarak, this is considered hiyal, or a legal ruse, since the individual concerned has no real intention of buying or selling the commodity. He engages in the purchase and sale transactions for realization of cash. Tabarak addresses a genuine need of the people, the need for cash. And I hope I have cleared the air on the subject. Yes, of course. Thank you very much. Tabarak is an Islamic financing method used to provide customers with liquidity. Tabarak is a means of generating cash by way of trading. The commodity is being traded only for the purpose of raising funds and not as an end in itself. It combines two separate sale and purchase transactions. There are 3 important rules to be followed to ensure that the Tabarak transaction is valid. Rule number 1. The commodity must be sold to a different person and not to the seller himself. Otherwise, it will be a case of sale and repurchase. There must not be a prior arrangement between the parties to a Tabarak transaction. Rule number 3. There must be a time period between each purchase and the subsequent sale. Tabarak is also the basis for the issue of Islamic covered cards. Some scholars have reservations against Tabarak based on the fact that Tabarak creates new debts far larger than the cash received. You may now reinforce your learning by going through this topic in the illustrated textbook and check your comprehension of the subject by attempting the questions in the workbook. Our next module will introduce you to the concept of musharaka. Mudaraba in deposit-based products. You had earlier mentioned about Mudaraba in the context of deposits. Yes, Mudaraba is by far the most preferred mode for managing customer deposits. Let us take a look at Mudaraba in a deposit-based product transaction. The depositor provides the funds. The bank acts as a discretionary fund manager for the investment of these funds. The profit-sharing ratio between the depositors as a group and the bank is determined upfront. For example, 70% for the depositors and 30% for the bank. Profit ratios. Can you explain on what basis the profit ratios are fixed? The share of profit can be in equal or different proportions, keeping in view the nature of the business and the contribution of the entrepreneur in generating profits. The profit sharing ratio can be 50 to 50, 40 to 60, 70 to 30, and so on. Sharia has left it to the mutual consent of the Rabul Mal and the Mudarib. But this must be decided at the time of entering into the contract. Subsequently, the ratio can be changed with the mutual consent for any mutually agreed period. As Rabul Mal and Mudarib, we cannot allocate a lump sum amount of profit for any one of us. Also, the share of profit will have no reference to a capital contribution. For example, it cannot be a percentage of our investment. Our profit in Mudaraba will solely depend on the net income from the business. I understand. This must be why as a Mudarib I cannot claim any salary. We will now look at the profit distribution ratio. Is it true that profit distribution ratio can vary according to the business situation? Yes, but this must be explicitly specified in the agreement. Let me give you some examples where the profit distribution ratio can vary according to the business situation. Case 1. If you trade in cloth material, you will get 33% of the profit. But if you trade in tailored clothes, you will have 50% of the profit. Case 2. If you do the business in this town, you will be entitled to 30% of the profit. If you do business in another town, your share will be 50% of the profit. If you earn profit more than 25% of the capital investment, the sharing ratio would change from 50-50 to 60% for you and 40% for me. Termination of Mudaraba. How can the Mudaraba contract be terminated if necessary? The Mudaraba can be terminated at any time by either of the two parties by giving a notice to the other party. The Sharia principles allow both parties to mutually agree on the period of the joint venture. The Mudaraba agreement will cover the instances when it could be terminated by either side. What will happen to the assets once the contract is terminated? If all the assets of the Mudaraba are in cash form at the time of termination and some profit has been earned on the principal amount, final accounting will be undertaken against the net profits of the Mudaraba operations. The capital provider will receive his capital. The profit shall be distributed between the parties according to the agreed ratio. In a trade-based Mudaraba, the termination of Mudaraba and final distribution of profits is made on the basis of the selling price or the fair value of the Mudaraba assets. The Mudarib can purchase the asset at a mutually agreed price. The Mudarib can sell and liquidate the asset so that the actual profit may be determined. Can I do my business with a partner as well? There is another doctor who may wish to share the clinic with me. Yes, a Rabul Mal can contract a Mudaraba with more than one person through a single transaction. In that case, both of you will be Mudaribs, but we shall treat you as one party. The bank can offer money to both you and your friend, so that each one of you can act as a Mudarib. The capital shall be utilized by both of you jointly. Both the Mudaribs shall run the business as if you are partners. The share of the Mudarib shall be distributed between both of you as may be agreed between you. What about food and personal travel expenses incurred during the course of the business? The contract of a Mudaraba does not allow the Mudarib to claim any personal expenses. However, when on a business trip outside his own city, he is permitted to claim travel, accommodation and food expenses. All such expenses can be charged to the Mudaraba account. This also must be specified in the Mudaraba contract. In case the assets appreciate in value over the period of the transaction, will this be taken into account at the time of profit-taking? The division of profits in a Mudaraba is always proportional. If the assets have appreciated in value at the time of liquidation, only this increase may be calculated as a part of the gross returns from the Mudaraba operations. Moreover, the original contract may contain a clause concerning the distribution of the value of the expected appreciation, specifying that a proportional share may go to the Mudarib. If the business creates ample goodwill, we may also share it with mutual consent. Suppose I wish to put in some capital of my own as well. Then it will become part of another contract which is called Musharaka. We can even have a joint Mudaraba and Musharaka contract. Thank you for being so patient with me. I've understood the concept of Mudaraba clearly now. Definition of Mudaraba. Mudaraba is a partnership agreement between a capital provider and an entrepreneur. The capital provider is called the Rabul Mal and the entrepreneur is called the Mudarib. Let us look at two different scenarios where Mudaraba is used by Islamic banks and the roles adopted by the banks in each scenario. Scenario 1, where the Islamic bank gives finances to Dr. Rashid through a Mudaraba arrangement. The capital provider or the Rabul Mal provides funds to the entrepreneur for doing the business. The entrepreneur or the Mudarib provides his expertise, labor and managerial skills. The profit is shared between the financier and the entrepreneur according to a predetermined ratio. Scenario 2, where the Islamic bank receives deposits from customers. Customers place deposits with the Islamic bank. The Islamic bank offers its expertise and resources to manage the funds. The profit is shared between the depositors and the Mudarib according to a predetermined ratio. In your case, we will invest the money to help you set up the clinic. You, as the entrepreneur, will contribute your services and skills as a manager and as a doctor. Well, that sounds very promising. So how do we go about this? Assalamu alaikum. Welcome to the e-learning program on Mudaraba. In this module, you will learn about the concept of Mudaraba, the definition of Mudaraba, the process of Mudaraba, profit calculations and accounting in a Mudaraba, and what happens in case of losses. There are two types of mudaraba and differences between them. Mudaraba in deposit-based products. Profit ratios. Termination of a mudaraba transaction.